Have you ever wondered how businesses keep track of their money? The answer lies in financial accounting. It's the backbone of every successful business. Imagine managing your finances without tracking income and expenses. The same principle applies to businesses. Financial accounting measures and communicates financial performance. Let's demystify financial accounting together. Financial accounting is the process of recording, classifying, summarizing, and interpreting financial transactions of a business. It's like keeping a detailed diary of a company's financial health, tracking every dollar that comes in and goes out. This information is then used to create financial statements, which provide a snapshot of the company's financial performance over a specific period. Imagine a small bakery. Every day they purchase ingredients, bake and sell pastries, and pay their employees. Financial accounting ensures that each of these transactions is accurately recorded. The cost of flour, sugar, and butter goes into the expenses category. The money received from selling croissants and cakes is recorded as revenue. These individual transactions are then grouped into categories and summarized in financial statements. For example, the income statement shows the bakery's total revenue, total expenses, and ultimately, whether they made a profit or loss. Financial accounting follows a set of standardized rules and principles known as Generally Accepted Accounting Principles, GAAP. These principles ensure consistency and comparability in financial reporting, allowing investors, creditors, and other stakeholders to make informed decisions based on reliable financial information. Just like any other field, financial accounting has its own language, filled with specific terms and concepts. Understanding these terms is essential to navigate the world of financial information effectively. Think of it like learning a new language. You wouldn't expect to understand a conversation in Spanish if you've never studied the language. Similarly, to grasp financial accounting, you need to familiarize yourself with its fundamental vocabulary. Don't worry, you don't need to become a certified accountant overnight. We'll guide you through the essential terms, providing clear explanations and relatable examples. Over the next few sections, we'll explore key accounting terms such as assets, liabilities, equity, revenue, and expenses. These terms form the building blocks of financial accounting and are crucial for understanding financial statements and a company's overall financial health. The foundation of financial accounting lies in meticulously recording every financial transaction a business undertakes. This meticulous record-keeping forms the bedrock of accurate financial reporting. Imagine a giant journal where every business activity involving money is documented. This journal in the accounting world is known as the general ledger. Every transaction is recorded twice, once as a debit and once as a credit. This system, called double-entry bookkeeping, ensures that the accounting equation, assets equal sign liabilities plus equity, always remains balanced. Consider a scenario where a company purchases a new computer for $1,000. This transaction would involve a debit to the computer account, an asset, and a credit to the cash account, another asset. This reflects the increase in one asset, computer, and the decrease in another, cash. Accurate and timely recording of these transactions is paramount. It provides the raw data for generating financial statements, which offer insights into a company's financial performance and position. The power of financial statements. Financial statements summarize data into meaningful reports, providing a comprehensive overview of a company's financial performance and position. They organize and summarize financial data, allowing stakeholders to assess profitability, solvency, and overall financial well-being. These statements paint a comprehensive picture of a company's financial story, enabling informed decision-making. Section 6. Assets. What a company owns. Assets are the resources a company owns and controls, holding the potential to generate future economic benefits. Imagine a bakery. Its assets include ovens, mixers, display cases, and the building itself. Intangible assets like brand recognition also hold significant value. On the balance sheet, assets are categorized as current or non-current. Section 7. Liabilities. What a company owes. While assets represent what a company owns, liabilities reflect its obligations, the debts and financial commitments it owes to external parties. These obligations represent future outflows of economic benefits requiring the company to settle them through the transfer of assets or the provision of services. Think of liabilities as the flip side of assets. Just as assets are essential for operations, liabilities are often a necessary part of doing business. Companies often take on debt to finance growth, purchase inventory, or manage day-to-day expenses. Using the bakery example, liabilities might include accounts payable, money owed to suppliers for ingredients, salaries payable, money owed to employees, and outstanding loan payments. These obligations represent future cash outflows for the bakery. Similar to assets, liabilities are classified as current or non-current on the balance sheet. Current liabilities like accounts payable and short-term loans are due within 1 year. Non-current liabilities like mortgages and long-term debt have longer repayment terms. Understanding a company's liabilities is essential for assessing its financial risk. A high level of debt compared to equity, known as leverage, can indicate greater financial risk, as the company has significant financial obligations to meet. Section 8, Equity, the owner's stake. Equity, the final element of the accounting equation, represents the owner's stake in the company, the residual interest in the assets after deducting liabilities. It reflects the amount of money that would be returned to shareholders if all the company's assets were liquidated and all its debts were paid off. Think of equity as the company's net worth. It's the value that belongs to the owners or shareholders after all creditors have been satisfied. For a bakery owner, equity represents their investment in the business and any accumulated profits that haven't been distributed. Equity can be increased in several ways. Owner investments. When owners contribute capital to the business, equity increases, and retained earnings, profits generated by the business that are reinvested back into the company, increase equity. Conversely, equity decreases when the company incurs losses or distributes profits to owners as dividends. For investors, equity is a key indicator of a company's financial health and growth potential. A strong equity position suggests stability and provides a cushion for creditors in case of financial difficulties. Section 9. Revenue and expenses, the drivers of profitability. Revenue and expenses are the lifeblood of the income statement, providing insights into a company's core operating performance. These two elements determine whether a company is profitable or operating at a loss. Revenue, often referred to as sales, represents the income generated from a company's primary business activities. For our bakery, revenue would include all sales of bread, pastries, cakes, and coffee. It's the inflow of economic benefits resulting from providing goods or services to customers. Expenses, on the other hand, are the costs incurred in the process of generating revenue. For the bakery, expenses encompass the cost of ingredients like flour, sugar and butter, employee wages, rent for the bakery space, and utilities. The relationship between revenue and expenses is crucial. If revenues exceed expenses, the company generates a profit, indicating financial success. Conversely, if expenses outweigh revenues, the company incurs a loss, signaling potential financial challenges. Understanding a company's revenue streams and cost structure is essential for investors to assess its profitability, growth potential, and long-term sustainability. Companies with strong revenue growth and effective cost management are generally more attractive to investors. Section 10. Why is financial accounting important? Financial accounting is far more than just numbers on a page. It's the language of business, providing crucial insights into a company's financial health. Understanding financial accounting is essential for business owners. It empowers them to make informed decisions and manage cash flow. Investors rely on financial statements to assess a company's health. Creditors use it to determine creditworthiness. Government agencies use it to determine tax liabilities. A profitable company provides job security and benefits. Financial accounting promotes transparency and informed decision-making. Section 11. Conclusion. Embracing financial literacy. As we've explored the fundamental concepts of financial accounting, it becomes clear that this field is far more than just numbers and equations. It's the language of business, a powerful tool that empowers individuals and organizations to make informed decisions, manage resources effectively, and navigate the complexities of the financial world. While this beginner's guide has provided a solid foundation in financial accounting basics, remember that learning is a continuous journey. The more you engage with financial information, the more comfortable and confident you'll become in interpreting financial statements, assessing business performance, and making sound financial decisions. Embrace financial literacy as an ongoing pursuit. Seek out additional resources, explore online courses, and consult with financial professionals to deepen your understanding. The knowledge and skills you acquire will serve you well in both your personal and professional life, empowering you to make informed choices and achieve your financial goals.